Go interactive with X-Ray, where we bring trading experts to you live in the platform. Choose sessions, watch live market analysis, and catch up on your favorite market insights anytime. Ask questions and go one-to-one with leading experts on gold, oil, FX, crypto, indices, and equities. X-Ray, your very own analysis team, right at your fingertips. That's higher trading from MarketsX.
2020 was a difficult year for us all. World economies have crashed. Financial markets showed us again how important it is to be aware of the global economy. And, believe it or not, many people have profited from the movements in the markets. This December, we bring you the biggest open source webinar series for beginner traders to help each and every one of you understand the basics of online trading and investments from industry experts. Learn from the CEOs is the biggest webinar series organized by InstructFX with the extraordinary participation of 5 CEOs of 5 top Forex companies worldwide. Join us live on Monday, the 14th of December at 1700 GMT for the grand opening with an amazing webinar on trading currency pairs with João Monteiro, CEO at 4XC. On Tuesday, the 15th of December, trading stocks and indices is the topic of the day with Phil Adler, CEO at ETX Capital, straight from the heart of London. Wednesday, the 16th, the week only gets better with Joe Rundle, CEO at Markets.com for an amazing webinar on trading commodities. Just when you thought that things can't get any better, on Thursday, the 17th, we have the cryptocurrencies trading webinar with our surprise guest. Finally, on Friday the 18th, it's your time to shine in the Fidelity Gala Awards, where InstructFX is rewarding you for watching us live with amazing prizes. Join the biggest open source webinar of 2020 and learn what most Forex brokers don't want you to know from 5 reputable CEOs. Click on the link below and reserve your seat for the biggest open source webinar of 2020, hosted by yours truly, Andrew, the Chart Whisperer. Learn, observe, trade with InstructFX.
And we're live. Good evening, everyone, and welcome to the second webinar of the series. How are you guys doing? How is everyone doing tonight? Big thank you to the ones of you that joined us last night for the Forex Trading webinar, and also a big thank you for everyone that will join us tonight for this amazing webinar. Please let us know how the sound is, guys. Let us know how the image is. You can type your comments or questions in the comments bar. And towards the end of the webinar, we will have a Q&A session, and we will answer all your questions, or most of your questions, if the time allows. Let's wait a minute for everyone to join us, and we start the webinar in 1 or 2 minutes, guys. We had a lot of registrations, a lot of registrations. So let's give everyone a fair chance to join the webinar. Okay, and then we're going to get started in about 2 minutes from now. All right? We're coming back live in 1 to 2 minutes.
Join us live on Monday, the 14th of December at 1700 GMT for the grand opening with an amazing webinar on trading currency pairs with João Monteiro, CEO at 4XC. Learn from the CEOs is the biggest webinar series organized by InstructFX with the extraordinary participation of 5 CEOs of 5 top Forex companies worldwide. Join the biggest open source webinar of 2020 and learn what most Forex brokers don't want you to know from 5 reputable CEOs. Click on the link below and reserve your seat for the biggest open source webinar of 2020, hosted by yours truly, Andrew, the Chart Whisperer. Learn, observe, trade with InstructFX.
Right. Good evening once again, beautiful people. Good evening, everyone. My name is Andrew, and for the last 10 years, I've worked in many retail and institutional Forex brokerages in Europe. Join me in this amazing journey and find out the hidden corners of online trading from industry experts. Learn from the CEOs is the biggest open source webinar organized by InstructFX this year with the extraordinary participation of 4 CEOs of 4 reputable Forex brokerages that decided to share their knowledge with you this year and help everyone understand the basics of online trading. My guest for this evening is working in the retail trading industry for over 30 years now and saw fortunes being made or lost in the financial markets. He witnessed the financial markets growing and changing in the last 3 decades. And tonight, he is here with us. Ladies and gentlemen, without further ado, please welcome my guest for tonight, Mr. Phil Adler at ETX Capital.
Hi, Andrew. Good evening.
Phil, how are you?
I'm good. Good. How are you?
Good, awesome. I'm very excited. I'm a bit nervous, to be honest, for this webinar. I don't get nervous very often.
You don't need to be nervous.
I don't get nervous very often, but now I'm a bit nervous. How are you? How was this year for ETX Capital, first of all?
Well, it was a crazy year. Like it was a crazy year for everybody, I suppose. So I would say at ETX, we had a year that was just generally representative. Like all companies in our space, we had to excuse me, we had to get all our staff working from home, which was no mean feat. We actually also moved office during the first lockdown, which was challenging. We actually, through all the volatility, we had incredible uptime on our trading platforms. And I suppose if that wasn't enough, we have new owners. Guru Capital took the reins of ETX.
I've heard. Congratulations.
In October.
Congratulations. I've heard that. I've seen it all over the news, guys. You are under new management.
We are.
The sky's the limit.
I think so.
Before we get into the topic of the day, I want to give our viewers a sneak peek of the past and show them how you started your career in the financial market. So please allow me to ask you, how did it all start for you? When did you get involved in trading for the first time?
Okay, I mean, I started working for IG Index in 1987. I mean, most people, they're a huge online trading company now. But in 1987, there were 20 employees. I was probably the 15th employee at the company. I worked on the dealing desk. I took spread bet orders for clients over the phone. All the business, of course, was done over the phone back then. I graduated to being a kind of senior market maker. We made prices in indices in and out of hours was the interesting one. And out of hours was just indices in those days. And I ended up being a sort of director in charge of all dealing activities after a few years. I was there for 11 years. It was a great place to learn about products, about service, and about our niche of financial services. I had a lot of contact with many active trading clients. I became friendly with many of them, and I was immersed in the risk, in the managing of our exposures. And of course, you know, some things never change. And I was also responsible for making sure that the client experience in those days was a good one.
Right. So I understand you've been in the industry for over 30 years now. Wow. Wow. What was different then versus now? How did it look back then versus nowadays?
Well, that's an interesting question. I mean, the obvious answer is the internet. So for, you know, really my first 11 years at IG Index, all the trading, all the distribution of the products was done over the phone. And so those client relationships were absolutely key. Now, I mean, today we can get to a very broad section of traders in a way that we couldn't, that we were constrained because of all the business that was done on the phone. But we have lost a little bit to some extent. I mean, the top clients still, or many clients still do trade over the phone. But the bulk of the clients who trade online, actually the real change is we have no relationships with those clients today in the way we used to 30 years ago.
Yeah. And how long did it take, by the way? How long did it take to place an order 30 years ago? And how long does it take to place an order today?
Well, you'll be surprised to hear, actually, we were really efficient. So you'd ring in, I'd take your order, you'd tell me, you'd ask for the price of FTSE, I'd give you a bid and offer, you say, okay, I want to lift the offer. I'd say, okay, you're filled at the price, and I'd book it, and that was that. I mean, I guess that's not a lot longer than it takes you to put an order in online today, Andrew.
Right. Well, I think today, I want to think today is a bit faster, to be honest, because you can trade online and open a buy or sell position within milliseconds. But if you're lucky, but yeah, it was quite fast back then as well, from what I've been told. Now, question from your experience: how long does it usually take until traders see the first consistent profit from the market?
Well, consistency, I suppose, is the key word.
Yes.
And you can see profits, but to be consistently profitable is a different story. And actually, you can't really be consistent unless you do certain things routinely. And you need to, of course, research your products. You need to understand the products. You need to understand the macroeconomic environment, because a piece of macroeconomic news can wipe out any profits that you might have made. You need to, in the same way, you need to pay attention to the economic calendar. And super importantly, you need to size your trades very sensibly. I mean, you can't be putting it all on black. You need to, of course, cut your losses and run your profits where you have the opportunity. And there's tools, of course, that will help you to do that. You need to use stop losses efficiently and routinely. And I guess also a bit of ice in your veins, a bit of kind of definitely helps keeping a cool temperament. It is always very important.
And if I might add, a bit of flexibility in the trading account never killed anyone.
Yeah, I mean, well, that comes back to risk management and, being diversified in your portfolio and also sizing those trades. I stress that point. It is very important. And as you diversify your portfolio, the sizing becomes a bit less important, but it's still there as something you need to watch.
I understand. What would you say are the most common mistakes when trading? What are the most common mistakes people make when they first get involved in online trading, beginner traders?
So I'll come back to many of the same points. So sizing the trade, going in too big on a trade is the starting point of any error, because if you size the trade incorrectly, if you go too big, it's much more difficult to make the right decisions thereafter.
It's gambling, basically.
You've got too much money on the line.
Yeah.
And then also not being disciplined with your stop losses. Those are the two absolutely key points. And they're both about discipline.
Discipline and obviously knowledge of the markets, and that's why we're here tonight. Now, I know your favorite asset classes are stocks and indices. How come? Why stocks and indices? Why not, I don't know, Forex, for example, or commodities?
Well, I suppose it's where I cut my teeth. So back in the day, in my first 11 years at IG Index, really the main asset class, unless there was some big commodity volatility, which there was on occasions, but the main asset class that the clients were interested in were the indices, the DAX, the Dow, the S&P, the FTSE, and I was an out-of-hours market maker there for 11 years, and that sort of stays with you. So I follow those markets because out of hours, that was my mindset for so long. And then I suppose for stocks, when I left IG Index, I went to work for a more mainstream derivatives broker called GNI, and we set up the first direct market access stock trading platform. And actually, I was there for 11 years. So I was at IG for 11 years, then I was at GNI for 11 years. And I was completely immersed then in stocks and only stocks, where we offered CFDs on stocks to individual retail customers, and we were the first people to do that, and we were the first people to create a trading platform that enabled them to trade those stocks on leverage online. So I really, that's where I cut my teeth, and those are the products that have stayed with me.
It makes a lot of sense. Now, is wealth created overnight, Philip? Can people get rich in a very short time from trading CFDs, for example?
Well, the surprising answer is yes. They can.
Is it?
But they can. The qualification is that they can lose it just as quickly. So you can get rich overnight, and then every chance that you will, of course, let your guard down, and the discipline will fly out the window. You'll think it's very easy, possibly, and that's when you need to be most guarded. It's like a football team when they've just scored a goal. That's a very dangerous time because you let your guard down.
Yeah.
So yes, of course, you can make money. You can be lucky. But actually, you can lose that and more if you let your guard down and discipline drops.
Very, very correct answer. What do you think a beginner trader should look out for when they start trading CFDs for the first time?
I think they should choose, if you're starting to trade for the first time, it's too difficult to trade across multi-asset classes. So choose the asset class that you're most interested in. It may be indices, stocks, FX, commodities. Choose your products, research your products, make sure you understand the macroeconomic environment that can really move the prices. Really be on top of the macroeconomic calendar, and then it comes back to understand the margins, of course, for those products, because the margins vary per asset class and per product, even within asset classes. Some stocks are 5% margin, some stocks are 20% margin.
Yes, correct.
So, and then of course, back to my same old mantras, which is trade sizing and making sure you use stop losses. So those are the things to look out for.
Very well said. Very, very well said. Now, talking about portfolios, you mentioned portfolios a minute ago. How different was a trader's portfolio 30 years ago? And how does it look nowadays, today?
Well, they don't look very different. So, which again comes back to risk management. So for the better traders, they size correctly, they have diversified portfolios. And back in the day, it didn't really matter whether you were doing that on phone or online. I mean, these days, it's easy to get in really small size. And actually, also these days, plenty of companies, ETX, of course, do it as well, offer demo platforms.
Yes.
To allow you to just, try a trading platform, to know your way around the trading platform, to understand margins and products. And I would recommend trying demo platforms. But how the portfolios change, not a great deal.
I'm with you. Okay, so traders always knew what a portfolio was and how to do it. You just have a bit more options, let's say, today. But in essence, it's the same thing that was 30 years ago for professional traders.
Well, I suppose, yeah, that's true for professional traders. I mean, the other thing, clearly, I mean, if we're talking about the difference between today and 30 years ago, it's so much easier to do your research today. There are so many different channels to pick up news and market, relevant market information, and whether you use, the traditional means or you use these social media channels or other channels, the research is definitely easier than it ever was.
Yes, no doubt about it. One click, you get the information.
Yeah.
Right. Thank you so much, Phil, for the words of wisdom. Now, are you ready for your favorite topic, stocks and indices?
I am.
Right. Let's do the presentation together. Back to school time. And let's show everyone how how easy it is to understand stocks and indices if someone explain it to you in the right way. Are you up for it?
I'm up for it.
All right, let's go. Let's get started. Guys, trading stocks and indices tonight with myself, with yours truly, and with Mr. Phil Adler from the heart of London financial sector, CEO at ETX Capital. First of all, we have to read the disclaimer, guys, for compliance purposes. All information presented during this webinar is from public sources and should be treated accordingly. Our content is intended to be used and must be used for informational purposes only. It is very important to do your own analysis before making any investment based on your own personal circumstances. You should take your own financial decision or independently research and verify any information that you see and wish to rely upon, whether for the purpose of making an investment decision or otherwise. We would like to draw your attention to the following important investment warnings. The value of shares and investments and the income derived from them can go up as well as down. Investors may not get back the amount they invested, and past performance is not a guide to future performance. Now that we have compliance out of the way, let's crack on with the presentation. So first of all, what are stocks? This is the most common question that I get, and I'm sure you get as well, or you used to get back in the day. What are stocks? A stock is a share in the ownership of a company. This is what a physical stock means, yeah, as physical as stocks can get. Am I right, Phil?
That is right. Yep. You part own the company.
Right. Stock represents a claim on the company's asset and earnings, and as you acquire more stock, your ownership stake in the company becomes greater. But this is not what you're doing when you're trading online. When you're trading online, you're trading contracts for difference. You're trading CFDs. And I want to show you some characteristics of stock trading. Obviously, subject to regulation, we have a leverage that varies between 1 to 5 and 1 to 20. The trading hours for stocks are 8 hours a day, Monday to Friday, because that particular stock is traded on a specific exchange, which typically is only open 8 hours a day. Stocks don't usually have an expiry date, correct?
Correct.
And the advantages of trading stocks, they react to the news. They're designed to go by nature, by definition. And US stocks usually have a negative correlation to the US dollar. Now, would you add anything else on top of this, Philip?
No, I think you made a good point that when you're trading the CFD, you're trading a stock lookalike. So the stock price moves penny for penny with the underlying. You're gaining an exposure to the price movement of the underlying stock, but you don't own the underlying stock. You own this product which tracks the price of the stock.
Very well said. Now let's move on to the other question, which is widely asked. What are shares? What are shares? The stock of a corporation is partitioned into shares, the total of which are stated at the time of business formation. Yeah, in layman terms, a share is a part of a stock, is a portion of a stock, correct?
Yeah, I mean, very often they're interchangeable terms, actually. You know, some people talk about stocks and some people talk about shares. But either way, you own, if you own the shares as opposed to the CFD, you own a slice of the company.
I'm with you. All right, let's move on to the next slide. So there is a difference between stocks and shares. Yeah, a share is a portion of a stock, basically. Now, how CFDs work. Now, you should know this by now, everyone. Guys, you were with me last night. CFDs work the same in trading stocks and indices as they work in trading Forex. Yeah, the contract for difference offers traders and investors an opportunity to profit from the price movement without owning the underlying asset. It's a relatively simple security calculated by the asset's movement between entry and exit. And the profits are realized on the difference of the price when you entered and when you exit the trade. Now, obviously, trading CFDs offers several major advantages that have increased the instrument's enormous popularity in the past decade. Advantages of to CFD trading include lower margin requirements, easy access to global markets, one-click access, basically, no shorting or day trading rules, and little or no fees. I'd emphasize more on little than on no fees, because as we know, as grown-ups, nothing is free in the world. So this is what CFDs are and how they work. Now let's talk a bit about the advantages. And now I'm gonna need your help, Phil, to determine some advantages or disadvantages. Let's say first advantage: CFDs provide higher leverage than traditional trading. Correct?
Correct. Traditional trading provides no leverage. CFDs provides some leverage. So absolutely right.
Standard leverage in the CFD market currently starts as low as 2% margin and can go up to 20%, correct?
Yeah. Are we talking about stocks still?
Yes, we're still at stocks.
Actually, if you go to certain low cap stocks, the margin can be higher than 20%. But actually, the most popular stocks that are traded are the high cap and the medium caps, whereby you're correct.
Right. Then lower margin requirements means basically less capital outlay for the trader or the investor and greater potential returns.
Yes.
Through leverage. CFD instruments.
Greater potential returns, but also, greater potential losses as well. That is the animal that is leverage.
It's a double-edged sword. Yeah, I keep mentioning that every time. As fast as you can make money, that's you can lose it even faster if you don't know what you're doing. Another advantage is that CFD instruments can be shorted at any time without borrowing costs because the trader doesn't own the underlying asset. And sometimes not owning an underlying asset is a bliss. Correct?
Yes, you make a good point that shorting is definitely a benefit and a feature. And has been for a long time, and there are almost no limitations on shorting. That's correct as well.
And now let's try and play it fair. Let's talk about some disadvantages, or what some people might consider disadvantages. Now, this is for you guys to make your own mind about it. If this is just a disadvantage, or it makes sense in 2020, 2021. Let's say disadvantages. CFDs offer an attractive alternative to traditional markets, but they also present potential pitfalls. For one, having to pay the spread on entries and exits eliminates the potential to profit from very small moves. Is that a disadvantage, that you have to pay a tiny commission, the spread?
I would say it depends on the profile of your trading. If you are looking at something that's moving, that's very volatile, then, and you are an occasional trader, it's not necessarily a pitfall. If you are a very active trader trading many times a day, and you're looking to, you're scalping effectively.
Yeah, exactly.
Then that is a drawback.
A tiny drawback. It doesn't mean you're not going to make money. The spread also decreases winning trades by a fairly small amount compared to the underlying security, which is correct. So, while traditional markets expose the trader to fees, commissions, and higher capital requirements, CFDs only trim traders' profits through spread cost. And they have also tiny additional costs like withdrawal fees we saw on some brokerages, or deposit fees, or things like that. But are they really disadvantages, that you have to pay a tiny commission to the brokerage for using their platform, for getting access to liquidity? Yeah, because you're getting access to the liquidity pool through the brokerage. Otherwise, you wouldn't have access to it with $500. Is that really a disadvantage?
Are you asking me, or is it a rhetorical question?
A bit of both. I don't see it. Personally, I don't see it as a disadvantage.
No, I think, again, it comes back to what your appetite is for leverage and the profile of your trading. If you're an active trader, CFDs make complete sense. The leverage, the ability to go short, for people that really want to trade actively, is a no-brainer. There is another cost of leverage that you haven't mentioned, which is the funding rate that you would pay overnight on any positions held overnight. That has to also be taken into account as a cost.
Yes.
But actually, leverage for active traders has always been, there's always been a huge appetite for leverage, and I can't see that changing anytime in the short term. Unless the regulators have something to say about it. But
they will Probably at some point. Now, a thing you mentioned earlier on, yes, there is a disadvantage, let's say, versus trading physical stocks, versus CFDs. I know you can't really short the stock during the day, or if you do that, you're going to have a very high cost, a very high spread. That's on stock trading. On CFDs trading, you just have the normal spread, which many times is on site. You can see how much the spread is.
Yes, I mean that's a good point. So the spread is transparent.
Yes.
So you always know what you're going to pay, and you're also right. Very difficult to short in the underlying cash market. Very easy to short in the CFD market.
Right. So the disadvantages are not really disadvantages. Let's move on. Talking about stocks. Let's talk about the stocks contract specification, which you mentioned earlier on. Every asset class has specific contract specification or different contract specification. Some assets have a different leverage or margin requirement. Others might have an expiry date, and others might not be available for trading. This is very important for everyone to know where to read all this information before they start trading, and that's in the contract specification.
Correct.
In this example, we're looking at Vodafone. We see that Vodafone has a leverage of up to 1:20, so most probably it's going to be 1:20. And we can also see the initial margin or the margin requirements, the maintenance margin and the initial margin. We can also see there's no expiry date on this particular stock. Stocks usually don't have an expiry date anyway. And we can also see the trading hours, very important. Okay, so understanding the contract specification, just like Phil Adler mentioned a minute ago, is mandatory. It's a must because different assets or different stocks have different contract specification.
I would also say that, Andrew, you can see those specifications on most of the companies' websites. They will give the contract specifications, and actually you'll see a lot of the key information in the trading platform. When you click on the stock, there's an information button, and also at the point of in the little panel where you do the trade, where you do the online trade, they will give you margin levels there as well.
Right, very well mentioned. So check your trading platform, guys. Regardless of the brokerage you're using to trade with, check the trading platform and check the contract specification. Now let's go to the next slide, and we're gonna move to indices very soon. How to trade stocks. Now, I mentioned a couple of times that stocks are designed to go up by nature, by definition, because any company that gets listed on the stock exchange has only one thing in mind: that share price to go through the roof as high as possible. So over time, stocks will move, which is why many investors choose to buy and sell a basket of stocks in various sectors and hold them for the long term. This is called diversification, or creating a portfolio. Investors use this approach do not concern themselves with the small movements of the market. The market has a wide range of investors and traders who buy and sell the stock, push the price up and down. In this example, we have Vodafone once again. We're looking at Vodafone on a 15-minute chart, and we saw Vodafone dropping and dropping and dropping. But what do we know? And please, Phil, correct me if I'm wrong. Stocks are designed to go up, and the owner of that particular stock will do whatever it takes, whatever is legally possible to push the share price as high as possible. Correct?
Yeah. I mean, they're designed to inherently raise working capital for the company. That's what they're designed for. Now, actually, of course, you're right that the owners of the companies do, of course, benefit from increasing stock prices, and they have, of course, skin in the game and want to see those stock prices rise. So I understand what you're saying.
Yeah, so after a drop, it's very likely to see the share price going up again, unless
there's something inherently wrong with the long-term trading outlook for that particular stock.
Yes, like we saw Boeing a couple of years ago when we had 2 or 3 737s crashing in a row. They got grounded, and since then the Boeing share price is struggling. It's trying desperately to go back up, but until those planes will be cleared and up in the sky again, it's going to take some time. Right, slide number 11. What moves stocks? Now, Phil, please answer the question. What moves stocks?
Well, lots of things. The macroeconomic environment, the actual, so the companies will release accounts on a routine basis, and those results will be better or worse than expected. And of course, that can move a stock price. There may be a listed stock will, there may be news about products and certain new products and new services that those companies are offering. So many things can move the price of a stock.
Bad earnings reports, poor governance, bad earnings reports, poor governance, economic and political uncertainty, as well as the unexpected.
Yeah, absolutely.
All right. Now, usually good earnings reports, increased corporate governance, new products and acquisitions, as well as positive overall economic and political indicators translate into buying pressure and an increase in the stock price. Okay, so the sentiment, the news is what moves the stocks. Unlike, let's say, currency pairs, where you can do a bit of technical analysis, elaborated technical analysis. Okay, on the stocks, one news is enough to completely shift the direction of the stock.
Yeah, true.
Let's go to trading indices. Trading indices. Let's see, first of all, what are indices? What is an index? So basically, an index or stock market index is a measurement of a section of the stock market. It's computed from the prices of selected stocks. In layman terms, an index is nothing else but a basket of stocks, correct?
Correct.
And you're trading on the overall performance of the basket instead of trading the stocks individually, one by one.
Yep.
All right. Let's move on to the next slide because we still have quite a few slides. Now, indices characteristics, and this is where you guys might find it very awkward, let's say, the beginner traders. Again, subject to regulation. We see the leverage not being the same with stocks, not being the same with currency pairs. The leverage varies between 1 to 10 and 1 to 100 when you're trading indices. 8 hours a day, just like stocks, because an index is a bunch of stocks trading together, Monday to Friday. Now, there is an expiry date on indices, correct?
Correct.
Right. And advantages of trading indices: high leverage. Indices, just like stocks, are designed to go up. And American indices usually have a negative correlation to the US dollar. Now, Philip, can I ask you something? Why do indices have an expiry date? And I bet this is the question on everyone's lips right now.
Well, I mean, there's two answers to that question. First is that most CFD and spread bet companies do offer a rolling cash product that does not have an expiry, and that's just like a sort of Tom Next that happens in the FX world. So there is that as a non-expiry alternative. But indices more generally do have an expiry because companies like ETX, they would mimic the products that are traded on the exchanges. They would hedge their exposures on the index products that are traded on exchanges, and those products that are traded on exchanges inherently have expiries. So we're mimicking exchange products and allowing retail traders to trade those exchange products that are generally only traded by corporate clients.
I understand. Very well explanation. Thank you so much for that. I couldn't have said it better. Now, let's move on to the next slide. We have many types of indices, guys. I'm just going to go briefly over this slide. Yeah, so we have many types of indices, like you have many types of commodities, like you have many stocks and many types of currency pairs. We're looking tonight. We're going to be talking about the most traded ones, which are the S&P 500, the DAX, the CAC 40, the Japanese Nikkei 225, and the FTSE 100 in the UK, of course. Now, this is a very heavy slide. I don't even know why I have this slide for beginner traders. I'm going to jump to the next one, understanding indices. We're just going to talk about the Dow Jones and the S&P 500, which you hear me talking about every single day at the market openings. So the Dow Jones Industrial Average is a stock market index that shows how 30 large publicly owned companies based in the United States have traded during a standard trading session in the stock market. The number that's next to the abbreviation represents the number of companies that are in that index, right?
That's right. So there's 30 stocks in the Dow, 500 stocks in the S&P.
And 100 stocks in the FTSE 100. Right. So the S&P and the Dow Jones are the most popular ones, the most popular American ones. You also have the NASDAQ. And on the Europe side, if we move to the next slide, you're going to see the FTSE 100, the CAC 40 in France, the Euro Stoxx 50, and the DAX 30, which soon will become the DAX 40, by the way. DAX announced they're willing to take more companies, to integrate more companies in the DAX. So very soon we're going to have CAC 40 and DAX 40 as well.
I didn't know that.
Well, they made the announcement a few days ago.
Okay.
ET225 is the big Japanese index. You have the Aussie 200, and you also have the Shanghai Composite, which is not on the map, which is obviously in China. So these are the most traded indices. I think you have over 2,000 indices worldwide or somewhere there.
I'm sure there are.
Yeah, a lot of indices, but the most traded ones, the ones you should know as a beginner trader, are these ones. If you manage to know these ones, you don't know anything else. You don't need anything else. Sorry.
Yeah. Andrew, I would say probably 80% of index trading at ETX is across 4 or 5 indices.
Yeah, the major ones.
Yeah.
All right. Let's move on to the next slide. We have some questions. Guys, by the way, don't be shy, guys. Type your questions, type your comments. Let us know if you're struggling with anything, if you don't understand anything. And that's why we're here. We're going to try and answer your questions. We're going to have a Q&A session very, very soon. Now, trading strategy for indices. At least from my point of view, from what I've seen in the market in the last 10 years, it's not really rocket science. You got to know your asset, check the US dollar, check for correlations, and check the contract specification. What else would you add as a trading strategy for indices, Philip?
Well, I mean, I would add that you have to sort of know your margins, which you might argue is part of your contract specification. Correlations is good. I mean, quite often we will see we'll see the European indices heading north, and there might be an out-of-hours Dow quote that doesn't reflect the fact that European markets are strong and there's perhaps a trading opportunity there. Similarly, when you get into the UK in the morning, or you get into you're looking at European indices and you see what the Asian markets have done overnight, and again there are opportunities because the correlation isn't as expected. So in terms of strategies, I just think of risk management really. More than strategies, I think that, are you sizing correctly? Do you have your stop losses? Are you and it may be that we've seen lots of traders who will be long the Dow but short of the FTSE because they think that there's going to be some divergence. And again, as a risk management strategy, that's very sound.
Which, yeah, true. But again, check for correlations. You need to know. I saw people that were, for example, on other asset classes, they were buying the US dollar index and they were buying gold in the same time. And I was like, what? So it all has to do, as you mentioned, with risk management. I think that's one of the best trading strategies, knowing the asset and managing the risk properly.
Yeah.
Let's move on to the next slide. Again, more contract specification. Just like stocks, guys, indices do have contract specifications as well. In this example, we're looking at the DAX 30. When DAX was trading at 12,000 long time ago, the leverage in this case is 1 to 200. You can see the trading hours. You can see the expiry date, if it has an expiry date, and so on. So it's mandatory that you know the contract specifications. Otherwise, you might end up opening half a lot on the DAX, thinking you only need, I don't know, $200 or $300 like you needed on currency pairs, and you might see the platform taking $2,000 from your trading account as margin. So you need to know the margin, the contract specification. Moving on to the next slide.
Actually, it's worth mentioning something else, Andrew, that again, sort of back, I know mentioned sizing trades a lot, but if you do size your trade as a high percentage of any funds that are on your account and the market moves against you, that broker, and you're a retail client, that broker has a regulatory obligation to close the trade if the market moves substantially against you. So you need to, as part of your risk management strategy, that has to play a part as well.
In other words, stay away from a margin call.
If you can.
Or stay away from a stop out. So yes, very good point. Very, very good point. And thank you, Philip, for making that point. Yes, stay away from margin call, guys. So if the trade goes against you and you lose over, I don't know, 30, 40%, 50% maybe from your account, then as Philip mentioned, you will enter either a stop out or a margin call, and that's when the brokerage has the legal obligation of closing that trade. Very well said. Very good point. Right, take profit and stop loss, because we both mentioned the stop loss many times tonight. Take profit is basically a target price for closing the position in profit, and same applies for a stop loss, but the opposite way. What the stop loss is the target price for closing position with a loss. Yeah, so you control how much you want to lose eventually, or to expose from your trading account.
It's just important, Andrew, that you think about those two levels before you open a trade. Because the emotion, once the trade is open and you see the profit and loss moving, the emotions take control, and so you're best placed to decide your take profit and your stop loss before the trade is open, and that's a basic point to note.
Very well said. That's why you need to know some basic technical analysis like support resistance levels, because that's usually when where the take profit is placed. Yeah, at the support resistance levels. And the stop loss, depending on your trading strategy. Some people use 1 to 3, 1 to 5. Yeah, when it comes to take profit and stop loss, it's entirely up to you. But yes, very, very good point. Now, moving on to the slide 21. This is an example of how to set how you could set take profit and stop loss on a short position. Yeah, on a sell position. The previous slide was showing you how you could set your take profit as sell on a buy position. This slide is showing you how you could set it on a sell position. Now, this should be quite clear and pretty straightforward. Yes, stop loss is pretty easy to understand, and take profit as well. Now, market trends. Is there any other market trend apart from a downtrend, a ranging market, and an uptrend? Obviously,
they're the ones you have to start with.
Yeah, exactly. This is it. I mean, looking at the charts the right way, you have a downtrend, you have a ranging market, and you have an uptrend. In stock trading and indices, you will very likely see the downtrend and the uptrend. I didn't see a lot of indices or a lot of stocks that were ranging. They either go up or down. People either buy them or sell them.
Depends on your time period. I mean, indices can range, but it depends on the time period you're looking at.
Yeah, but the proper time period, 4 hours, daily, weekly.
It depends what you mean by range trading. I mean, index can do a range trade, and then the opportunities are not what they would otherwise be. But but then you're trading looking for a breakout. At the point of breakout, clearly you would be more confident with your opportunities.
Yes, that's correct. Now, I think we're close to the Q&A. We have a few questions. There we go. Slide 23, Q&A. Right. We have a few questions, guys. Let's have a quick look. Now, again, quick disclaimer for the questions. We are streaming live on 3 different sources, guys. You might not see all the questions, that I'm going to read on your streaming source. That doesn't mean they don't exist. They are from the other stream source. Right. We don't have a lot of time. We're limited to 50 minutes to maximum 1 hour. But I'm going to try and take some questions, and let's see who will answer. Now, first of all, Dennis, thank you ever so much. Dennis is saying this was a lovely presentation. Thank you so much. Dennis is one of my clients. I've been mentoring Dennis for quite a while. Who knows? Maybe we're going to have a webinar with Dennis. Thank you so much for the kind words, Dennis. Right. Good question. Praveen is asking, what leverage does ETX Capital offer on stocks?
It depends. It depends on the stock. So we range from 5% on so for professional clients, it'll go from 5% right up to low cap stocks would be 50% or higher, but generally start at 5%.
All right. Right. Now, Phil is asking, another Phil, is it worth trading only stocks?
Could you repeat the question, Andrew, please?
Is it worth trading just stocks, only stocks?
Yes, I think so. I come back to something I said earlier. You've got to decide what the asset class is that you're most interested in. And yes, I mean, stocks is perfectly good. Lots of people do only trade stocks. At ETX, we have a desk that just facilitates people who just want to trade stocks over the phone. Of course, you can trade the full range of UK, European, Asian, and US stocks online with ETX. So it's a very popular asset class for our traders.
Right, and right, I'm going to take two more questions, guys. Dilip Patel is asking, how about the DAX or CAC 40? I don't know what you mean with the question. How about why didn't we speak about the DAX or the CAC 40 tonight? We did. Let me know. Get back to me with a complete question, and then I'll do my best to answer. What else do we have?
I think for Dilip, it's just worth saying that the DAX, so the DAX, the Dow, the S&P, and the FTSE are our main index products traded. So the DAX is right up there. They all have competitive and sensible margin levels. The CAC is probably the tier below.
Right. I hope that's what he
may answer the question, or it may not.
Yeah. Now, Krishna, I love the presentation. Well done. Thank you so much for the kind words, guys. That's why we're doing this. And Phil, thank you ever so much for accepting the challenge. It's not very common. It's not very often when you see the CEO of a reputable Forex brokerage from the heart of London agreeing to come forward and literally show people, explain people the basics of online trading. And I thank you so much for this, especially being your favorite asset class. Yeah, having the two asset classes that you love the most, stocks and indices. But anyway, thank you ever so much for being with us tonight. It's been a great pleasure.
I've enjoyed it.
Thank you so much. Do you have any closing statement? Do you have anything else you would like to add before we end the broadcast?
Well, that's caught me a little bit on the spot. Not really. I would say, actually, I've been immersed in trading, as you've rightly said, which makes me sound very old, for 30 odd years. My appetite is exactly as it was 30 years ago. I find it fascinating and a stimulating environment to work in. I'm lucky to work with some great colleagues and really a fantastic company, ETX, with a trading platform that we're very proud of. And I hope to be in the industry for many years.
Yes, so do I. I see you guys are growing. Every day you're posting on LinkedIn, new people employed, reputable people of the industry with heavy experience. Yeah. Are you planning something? Are you cooking something? Do you want to take the lead?
You'll just have to wait and see.
All right, fair enough. Right. Phil, thank you ever so much for being with us tonight. Guys, thank you so much for joining us, for asking the questions, for being active, and for wanting to learn. Join us tomorrow night for an amazing round of trading commodities, and on Friday evening. Will you join us again for the gala on Friday evening, Phil?
Sure will.
Right. On Friday evening, guys, we have a big surprise for everyone that's watching. So this was it from our side tonight. Thank you so much, Phil Adler, for your time and for the lovely, lovely explanation that you provided. Guys, thank you for watching. Join me tomorrow afternoon for the US markets open. And shortly after that, for a new round of market talks, commodity trading with Joe Randall at markets.com tomorrow evening. This was it from our side. Remember to trade responsibly and may all your trades be in the money. Have a lovely evening, guys. Have a lovely evening, Phil, and thank you once again for being with us tonight.
Good night.
All the best.